please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Good afternoon. You're with us here on a fresh new edition of Midcap Radars. The market is down about 70 points and it's looking pretty bad. It's looked pretty bad actually now for a while. We were down 80, so there is what a 10-odd point recovery, under 10-point recovery from the lows, but we're at 10,122, which means, the market continues to flirt around 2018 lows. Midcap index is down 1.5%, complete washout there. Advanced decline. There are almost 7 stocks which are lower for every one stock which is higher. So this is a down and out market, and what a way to start the week. One would have thought after Friday's complete washout, today would be a little better. People were attributing many things like the FTSE rebalancing for Friday's sharp and brutal sell-off when global markets were not selling off. And they were saying, well, that was one-off. Monday will be better. But nothing of that sort. This is just looking worse and worse, unless, of course, over the next 1.5 hours or so, we see something different. With me is my colleague, Sumaira. Sumaira, hi.
Hi, Prashant. Good afternoon to you as well. And, even for the European markets, I think by and large, the opening would be quiet to lower. The key monitorable now for the global markets will be the Fed meet that's due this week. And by and large, the expectations are that in his first FOMC meet, Jerome Powell, who's the new Fed chair, is looking to hike rates.
Sort of top headlines. Ashwani Gujral is with us as always on the top of the show. Ashwani, thanks very much. Good afternoon. Still makes sense to sell here or time to cover?
I would think it's time to cover. We've been selling off since 1 o'clock yesterday on Friday, and we are still selling off. It's almost 1:30. So I would think that just for the immediate intraday type of time frame, the selling may have been overdone, and right now is a good time to cover intraday shorts, and even a little bit of short covering will have a large impact because the entire market is now biased to one side. The objective thing that I look for is that you have hardly now 200 advancers and 1430 decliners. Once it starts to get around this 150, 200 advancers only, and that is often the time that the market tends to rebound. I'm talking about a rebound, so that should be kept very clearly in mind. A rebound could be a 20, 30 point style rebound, which just shakes out a bit of the shorts. Having said that, I think there's still pressure on the downside. So Just Dial is a sell with a stop of 428, target of 405. Union Bank is a sell with a stop of 98, target of 90. And DLF is a sell with a stop of 219, target of 206.
Ashwani, so cover for now, intraday bounce could be small. If you're not already in the market, been watching this from the sidelines, would the better thing to do would be to sell on that rebound? However sharp they may be? Is that the better trade?
See, chances are we will test the 10,150, 170 zone, which held this market even in the morning and earlier on. So there's a chance that you go back and you retest those levels. Once we get there, I think those would be again good levels to sell into.
All right, Ashwani, thanks very much for joining in with your afternoon trades. Well, the single biggest risk for India is that we have regulatory overkill. That's the word coming in from Ruchir Sharma, the head of emerging markets at Morgan Stanley Investment Management, who was speaking at the Rising India Summit. Well, he spoke about banks privatization, and he adds that the banking system needs to be privatized, is being privatized rather, but at a huge cost.
A couple of years ago, there was a lot of optimism, almost as if it was only a matter of time before we would get to 8 to 10% economic growth. And that really hasn't happened. Now, I think we are sort of entering a very critical period where I think that the global economy is doing well.
Yes.
But as far as India is concerned, it's not been able to fully participate in this massive global economic revival that we have seen over the past 18 months or so.
What's gone wrong?
Well, I think there are 2 or 3 factors. There are the obvious ones which we have spoken about demonetization and the teething problems with GST. But I think that the one sort of really big problem which hasn't been fixed in India, and if you look at it, that if you look at all the major economies in the world, when they went through some sort of a banking crisis, until the banking system was fixed, it was very difficult for those countries to get back to their full potential. This goes back to Italy, to the United States. So the banking system, the financial system is really the artery. It lies at the heart of what a nation can do and in terms of what its growth rate is. And that, for me, has been the single biggest shortcoming of the last few years.
It's been the biggest missed opportunity. You believe that the government should have exercised the political majority it enjoys to be able to drive through banking reforms, which in your mind means privatization.
Yeah, because, I think there's been a lot of debate about privatization and whether that's the thing to do or not to do, and all sorts of ideological debates have come about. For me, it's a very simple number which tells you about really what's going on out here, which is that in India, like as you know now, about 2/3 of the assets are with the public sector banks. This is the highest of any democratic country in the world. The average across emerging markets is about 1/3 in terms of what it is. So every country needs a public sector to meet some social objectives. But there is no country like India where the figure is this lopsided. So I think that, for me, that's the issue. It's not about public versus private. It's about a balance. That in the banking system, the average number in which the share is there across the world is about 1/3, and India's at 2/3. And there's a side effect to this, which is that if you look at all the incremental economic the financial activity, it's all happening through the private sector banking in terms of whether it's got to do with trade finance, credit cards, the massive retail lending that we are seeing. A bulk of it is happening through the private sector banks anyway. So what India is seeing is really privatization by malign neglect.
And do remember, you can catch this entire conversation this evening at 6 and also at 9:30 tonight only on CNBC TV18.
All right. We also had State Bank of India Chief Rajneesh Kumar defending public sector banks. Faced with questions and criticisms after the PNB fraud came to light, he said that India should not forget the contribution of public sector banks, especially towards funding the infrastructure development we've seen through the decades here in the country. Listen in.
My view is that ownership should not matter. Public sector, there are ample examples of very good companies, excellent companies. Private sector, again, very good examples, excellent companies and very bad companies. So there is no uniform prescription that if you are in private sector, then you are good.
The market, it's been a bit of a bother actually. So the Sensex is down about 200 odd points right now. The Nifty is down 0.7%, closer to the 10,100 mark. The Midcap index now down about 300 odd points. So joining in now to discuss the technicals of trade, we have Jay Bala of cashthechaos.com. Hi, Jay, good afternoon. Thanks much for speaking with us. So we're now in that support zone of about 10,036 to 10,168. What's the sense you're getting that this looks to hold out for now at least?
Yeah, I think the market has got a little bit of selling left in the short term. I think the important support was 10,140. That's been broken, and the next closest one is at 10,080, and the next to that is 10,033. So, I think the market needs to find support in one of these zones. Otherwise, we are looking at the markets dropping to somewhere close to 9,800. But having said that, the medium-term picture doesn't change at all. And we are looking at the market scaling record highs in the second half of 2018.
Right. Ajay, good afternoon. So this is just a correction which is going to pass. I mean, that's how you're looking at this, right?
Yes, that's right. This is a correction that's going to bring in a lot of fear, which has been missing in the market for the last few months, and every dip has been bought. And this is, doing what exactly the market must do, shake out the weak hands and, bring in the strong hands later on.
So you gave us supports, etc. I mean, 10,080, 10,033. But where, to your mind, do you have a level in mind where we'll finally get to?
There's a good possibility that the market is going to go to 9,800. But, it's not a sure shot thing. I spoke to your colleagues on the 16th of February. I'd said, given a probability of about 25 to 30% of the markets getting close to 9,800. And the market is exactly doing that, but it's doing it with a greater chop. So, I think I would still, watch out for a spike high in VIX, which has been missing at this time. And and the important thing to note at this point of time, if you take 10,170, 11,170 odds, which is the record highs, and if you look at the markets on the left side and the right side, there have been more number of days that's been trading on the right side to get to 10,100, which basically means the market took less time to climb to record highs than the markets took the time to drop from 11,100 to where it is at this point of time. That is a typical sign of a correction. So, although it might look scary in the short term, the medium-term picture looks quite safe for me.
What about the Nifty Bank?
Nifty Bank is, heading to very important support at 23,600, and that needs to hold. That's pretty important for the sector to hold, and I think I have a feeling that will hold. And more than the banking space, I think it will be the financial sector, financial services sector, which will do well going forward. And within the banking space, it's pretty obvious that the market's going to reward the private banking space rather than the PSU. But I think there is a good relief rally coming for the public bankings, and but it'll just be that, nothing more than a relief rally.
Mm-hmm. So you said from medium term, market still looks good, right? I mean, you're talking about going back to previous all-time highs. So is it going to take a long time for this to resolve itself, or what is it in terms of time correction? What are we looking at?
I think we are looking at somewhere close to another a few weeks. Nothing beyond that for this for this correction to last. But once it's done that, I think we are looking at record highs in the next quarter probably. No, not beyond that. And and coming to specific sectors, I think IT will be doing pretty well, and it's holding up pretty well at this point of time. And you can pretty much close your eyes and keep your hands on any of the IT names. You're definitely bound to do well. But if that is what you want to do, you don't want to throw darts. Focus on pretty well-doing names like L&T Infotech and Hexaware or Tata Elxsi. Mostly the mid-cap name, even NIT Tech, HCL Tech in the frontline name is likely to do better than TCS or Infosys.
Mm-hmm. Okay. Any other sort of stocks which you think, while the market may continue to correct, have already are close to completing their respective corrections, and maybe time to get back in?
Yeah, that's right. I had said the financial services sector is likely to get rewarded because of the problems that's in the banking space. And last time I was on CNBC, I had spoken about Bajaj Finance. That was about 1640. It has come up to 1730 and then just pulling back. So watch out for this particular name. It's likely to take out the record highs and go to somewhere close to 2200. And even if you look at names like Thomas Cook, that's had a breakout, and that's likely to go to somewhere close to 320. And if you look at something like Shriram Transport, that's had a short-term breakout, and that's also likely to do pretty well.
Mm-hmm. Any nifty names in particular, Jay?
I always have a soft corner for Reliance, and Reliance is likely to hold 875 to 850 zone pretty well. And if you recall, I've been pretty bullish on it for a long term, and it's come exactly to where I had expected it to come. I think there's just one more leg pending for Reliance to complete its long-term price move, and I think that's it's heading somewhere close to 1100. Which has been my target since 2015 when the bull market began for this stock, and I'm bullish on Brent too. So given that, I think you can have a pat trade on a long upstream oil companies and short downstream oil companies.
Okay, Jay. Even as we're speaking with you, we're down 88 points now. So this is a new low for the day and just keeps going. 10,106. Immediately you said 10,080 and then 10,030 or so, right? Supports.
Yeah, that's right.
Immediate.
That's right. Yeah.
Supports.
Yeah, I would expect some bounce to come around the 10,080 mark, but the durability of it is something I can't predict at this point of time. I would watch for quality of the bounce to tell me where the market is going. But I'm pretty much looking at accumulating calls for the May series or even June series. When the market comes further down, I expect the premiums to get deflated. That'll give me a decent entry point for the Nifty.
Okay, Jay, we'll leave it there. Thanks very much. Appreciate your time and perspective. Jay, I mean, is essentially saying that he's going to accumulate calls for the next month or the month after. But for now, we're down 80, 88 odd points. He did mention that the Nifty could eventually head down to about 9,800 or so. This entire thing may play out in the next, 2 weeks, 2 or 3 weeks, next few weeks. And in the first quarter, next quarter, which is the first quarter of 19, he expects the Nifty to actually head right back. So while this is a correction, as all corrections do, it does create a fair bit of self-doubt, fear, even some panic. For now, the Nifty looks like it's breaking 10,100. At this point, advanced decline is looking pretty terrible. 1834 stocks are lower.
The market, it's just not looking too good. The 10,100 mark just about holding out for now. But indications are that perhaps it could give way. So about 0.9% down now on the Nifty. The Sensex has extended its losses to about 250 points. Likewise for the Nifty Bank, and the Midcap index is now seeing a cut of about 330 points. But a lot of people have been advising that perhaps many of these dips are good buying opportunities should you stagger your purchases. And even Ajay Srivastava of Dimensions Corporate Finance Services has laid out some large cap bets. He's looking at private banks, select FMCG names like ITC, Bata, and lots more. Hear him out.
We are certainly buying large banks, private banks. We are certainly buying and decent quantities. It's not small amount. We are buying decent quantities of large banks because we believe that, if let's take this a step year forward with all the uncertainty and everything together, it's only going to help the large private banks. It's not going to take away from their value. So I think what we are seeing, a crisis in the PSU bank, is a godsend gift to the private banks today at this point of time. You can't not buy into those. So private banks, we're definitely buying. Hindustan Lever in our stock. We're buying back Bata again. We had sold off. We're buying back Bata again. We got a lot of holdings in Britannia at this point of time. Beautifully positioned stock in our view. We have got holdings in Jubilant Foodwork. Yes, we got significant hold Jubilant Foodwork at this point of time. And now we are looking at whether ITC makes some sense. ITC perhaps, timing-wise, we can wait a while, but it's at the cusp where you can see a major transformation of the stock in terms of FMCG.